And our market monitor guest today says now that the long-awaited jobs report is behind us, investors will turn their focus to fundamentals. He's Mark Luschini, Chief Investment Strategist at Janney, Montgomery, Scott. Mark, welcome. Good to have you with us.
Thanks, Tyler.
What did today's jobs number say to you about the economy, the Fed, and maybe most important of all, what's next for stocks?
Well, I think as it relates to the economy, it said that it's becoming increasingly sturdy here as we move forward in 2013, and it really belied a couple of the other economic reports that we had earlier in the week, the ISM manufacturing and services indexes, as well as the ADP number, which showed some weakening employment data. So this was a very nice offset and continues on the string of job growth we've seen in 2013 that is averaging about 189,000 a month. At the same time, it probably, and why the market, I think, reacted so positively to it, suggests that it's kind of a Goldilocks number in terms of Fed watching. And that has to do with the fact that the Fed has basically stated that what they're looking for is 200,000 jobs a month to be created for a 4 or 5 month period to give them probably enough evidence that might warrant tapering of their quantitative easing program. This number was good, but just shy of that number, which suggests a threat of an imminency to that tapering program is probably at least been deferred, and I think it bodes well for stocks going forward because obviously it's an underpinning of an economy that's continuing to get some traction positively, which is good.
But we've also had an awful lot of volatility, Mark. What is that volatility in the market telling you?
Well, so it's telling me that obviously as it relates to the economic fundamentals, the market is basically not paying a tremendous amount of attention, at least of recent, and it's all about what the Federal Reserve is likely to do. Obviously, they have a big checkbook, and their consequences in the market is being debated every day relative to what they may or may not do with regard to opening or closing that checkbook. And so I think, though, now that we had a data point that likely defers that tapering discussion, at least the heightened chatter we've had of recent, I think that volatility at the same time will taper off.
Let's get to some of your stock picks if we might, and alas, we have to go relatively quickly. So a quick thought on pick number one, Citigroup.
Citigroup, big money center bank, trading at 8 times or 8/10 of book value, cheap. We think the bad bank part of it will continue to unwind and lead to probably a dividend increase in the next year for Citigroup, which ought to attract more sponsorship to the stock.
Next on the list is Emerson Electric.
High-quality industrial company. We like a pro-cyclical stance at this juncture, given our prospects for economic activity going forward. Again, a great enterprise, global in nature, 2.8% dividend yield.
Conoco, you must love that 4% yield.
Well, that's certainly the hook, Tyler, is that big, fat 4.2% dividend yield, 10 times earnings, heavy position in North America energy, in which there's a tremendous renaissance, if you will, relative to that, which we think has a long, long runway.
Next on the list is Apple, and I was curious about this because that stock has really been all over the board. Why do you like it?
Well, we like it because valuation is certainly there to support the share price. It's kind of in this latent period in between products, so there's not a lot of excitement about its shares at the moment, but we think that'll change here in the coming quarters. But along the way, you get a 2.8% dividend yield, and it generates $16 billion in free cash flow every quarter in the meantime.
Mark, we have to leave it there. Do you have any disclosures on those 4 stocks you mentioned?
We own all 4 on behalf of clients, Tyler.
All right. Mark Luschini of Janney, Montgomery, Scott, thank you very much. Have a great weekend.